Great to see you here. My name is Luc de Koster, founder of the Koster Academy. And in this video, I want to talk about evaluating offers. So you're doing procurement, you're getting some offers for you, and you have to evaluate them. So what are the things that we can do? What tools can we use and what principles are applicable? We keep it rather simple. We just give the principles, but there may be a lot of other tools that you are using in your organization to select the best supplier. Now, before we continue, don't forget to click on the subscribe button, click on the bell button, and every time we have a new video, YouTube will inform you about it. So let's have a look at the principles of evaluating offers. When we receive an offer, we have to review that offer. There are a lot of administrative elements that we have to do. We have to see that everything is legal, things like that, that it complies, the products that they offer, that they comply with our requests. But we also look at quality, warranties, timing, cost, and those other parameters like I mentioned before. Now, different methods can be used. We have the break-even method, we have the make or buy method, and we have, for example, a decision matrix that we can use. Now, the break-even method is looking at the point from which it is profitable, create something to build some elements. A make or buy the method is to evaluate if we should buy the product or we should make it ourselves. So also very important to see. And a very important parameter in evaluation of contracts is what we call a decision matrix. Here we have a complex combination of criteria and weights, and it's also called Multicriterion Analysis. My professor said at the time, you cannot add apples with oranges, but you can add fruits with fruits. So basically, that's what the decision matrix is doing. It's transforming all those different parameters in fruits instead of apples, oranges, and bananas. Now, when we look at the elements for source selection, when we look at this, we look at the capability of the supplier. We look at the product cost and life cycle cost. It's not only the product cost, but also what will be the cost over the life cycle when we have to improve, when we have to add some solutions, the maintenance, the energy consumption. All these elements have an important role when we are selecting the suppliers. And sometimes we used to concentrate, or in the beginning we used to concentrate on the initial cost, but there is more and more the tendency to look at the life cycle. Delivery times, what are the possibilities for delivery? Is that compliant with what we expect? The technical expertise of the company, of the supplier, and the approach that they have. Specific relevant experience, you can have a list of references and things like that. Compliance with the work plan and the statement of work. Employee qualification, availability and competence like certifications, PMPs, Cisco certification. Very important to financial stability. We've spoken about that before. One university here has very strange furniture, and what happened there is they made a contract with the supplier. Basically, they didn't verify the financial stability, and the supplier went bankrupt. They already paid the part, so they had to find a new supplier very quickly, and of course overpaid. Management experience of the company, suitable for knowledge transfer and training, and processes that can exist, also how to share information and how to resolve issues, help desk. I don't want to deal with a company which has no experience when things go bad. It means either they didn't have anything, or they don't have the experience, or they didn't build any system to deal with that. So it's always very important to understand, in case something goes wrong, how does the company deal with it? What are the processes? What is the infrastructure that they have and that we can use or that can be used to resolve problems? The first element I spoke about was the break-even analysis. We compare the cost of running a business with the generated revenues to determine the point from which we make a profit. So we have here the break-even point is the point between loss and profit, and we see it here on the graph. We have different elements. We have fixed cost and variable costs, which lead to the total cost. The total cost is the sum of the fixed cost plus the variable cost, and the variable cost is, for example, V is the cost for 1 unit multiplied with the number of units. The second element is the revenue. The sales revenue, is the sales revenue for 1 unit multiplied with the number of units sold. And we can find the break-even point, which is in fact F divided by the difference of the sales revenue minus the cost. And we can see when we are at the left-hand side of the break-even point, we are in the zone for the losses. And on the right-hand side, we are in the zone for the profit. And of course, we want to be in the right-hand side. Let's have a look at an example. Here we have the different formulas. The TCM, I put there the index M because we will use it later in some other example. So we have TC for making, the M is for making, make or buy. So we have the fixed cost plus the variable cost. The revenue is the revenue for 1 unit multiplied with the number of units. And we have the break-even point like we had before. Now, when we look at the different numbers, we say that the fixed cost is 25,000, the unit cost is 250, and we can sell 1 item for 550, whatever the currency is, and we see that we have a break-even point with 83 units. Let's have a look at the graph for this. So here we have, in fact, the fixed cost is 25,000. The variable cost is 250 N. So we find the line with the cost, total cost is 25,000 plus 250 N. The green line is the line with the revenue. So we start from 0 and the equation is 550 times N. And we find the break-even point where we have, in fact, the losses equal to, or let's say losses equal to 0, profit equal to 0. It means that the revenue is equal to the cost. So to the left we have the losses and to the right we have the profit. Now we look at 150 units. 150 units, we are at the right side of the break-even point, which means that we are in the profit area and we want to know the profit. So the profit is the cost basically minus the revenue minus the cost. And when we have the equation here, we have the profit is N times S minus V minus the fixed cost. With some mathematical manipulation, we can find this very quickly. And we see that the profit here is equal to 20,000 once we produce 150 units. We can do the same, what we call a make or buy analysis. Here we compare the cost to buy the product or service or to make it ourselves. When we look at this, we see the 2 elements here. Here we have the green curve, which is the cost curve to buy, and the red line is the cost curve to make the goods. And there is a decision point, which in fact is the difference between buy or make. And when we're at the left of the decision point, we will buy it. When we're at the right side, we will make it. Now we find the equations. The total cost to buy is the fixed cost to buy plus the variable cost to buy multiplied with the number of items. The total cost to make is the same, but now we look at the elements to make the goods. And we have a decision point, which is in fact Fm minus Fb divided by Vb minus Vm. So the absolute value of the difference of the fixed costs divided by the absolute value of the variable cost. I put, let's say, the absolute value there because the decision point, depending how we do the subtractions, may end up into a negative value, but we have to have, of course, a positive value. Let's have a look at an example here. So we have again the different equations and let's have a look at some numbers. The first element that we have is the total cost to make is 25,000 plus 250 N. That's the same curve that we had before, but we have the total cost to buy, which is 15,000 plus 500 N. It's logical that the fixed cost is higher, but the variable cost will be lower when we buy, when we make the goods. So we have those elements here, and we can find, using the formula, a decision point where we find 25,000 minus 15,000 divided by 500 minus 250, and we find the decision point here, which is equal to 40. Now we want to make N, we want to make 50 units, or we have 50 units that we need. So we have to say, do we want to buy or to make it? And we see that the make cost is lower than the buy cost. We're at the right-hand side of the decision element. It means that we will make the goods instead of buying them. So this is also an example that we can use when we are evaluating the different elements that we have. Now, sometimes to make, we also have to look at the total cost of ownership, which is also a very important point when you're dealing with certain companies. It can be a cost that you're forgetting, and we had some customers who made their own security system to communicate over the internet. It's very good, but what they didn't count in is that they have to update it, and AT&T was providing that solution with all the updates and everything. Although it was cheaper to make it for themselves, the CTO was not really happy, because it would mean that they have to keep on updating it, while buying a service provided by a company that is specialized in this would have been a better solution. Now, a last element to look at is what we call the multi-criterion analysis. We spoke about that before. We look at different solutions with their costs, and we look at different parameters that we are going to consider. We look at the selected parameters that we have to evaluate. We give a weight to them, so every parameter has a weight, and the maximum of the points is given there. What we do next is, for each of those elements, for each of those parameters, we will evaluate the different solutions, and we will make a total. We will multiply the number of points with the weight. Basically, we find that some product for solution 1, when we do it, when we find 85 times 45 plus 75 times 25 plus 25 times 15 plus 35 times 10 plus 95 times 5 divided by 100, we find 6,900. What we do then is we divide the cost by the number of points, and we find the cost per point, which in solution 1 is 37.0. For solution 2, we have 7,225 points, and a cost per point which is equal to 39.4. And for solution 3, we have a total points, or we have total of 7,950 points and a cost per point of 36.4. Now, when we look at these elements, we have that allocation of the points for the specific solution, and then we have two possibilities. We can select the solution with the highest number of points, which would be the solution 3 with 7,950. This is basically the best solution. And then we look at the lowest cost per point. This means is the most efficient solution, which is also solution 3. What's the problem here? First of all, people have to understand how this works, and you end up in this case with the most expensive solution, and you have to explain that to the people. Why is this solution the best? Because people are always attracted to buy solution 1. Although it's cheaper, the point is not so good, and it's not a really efficient use of the solution. The most efficient, the lowest cost per point, is basically the best solution. Now, it depends how you do it. There are different variants, but this is a very interesting way to analyze the different offers that you may have. So that was it for evaluation of the offers. I thank you a lot, but don't forget to click on the subscribe button, click on the bell button, and every time we have a new video, YouTube will inform you about it. Thank you very much, and I'm looking forward to seeing you in the next video. Bye bye.